Welcome to Marmor webinar series. This is Rajesh Deenadayalan here. I work as a senior research analyst with Marmor. Marmor is a majority-owned subsidiary of Kuwait Financial Center Markets. Established in 2010, Marmor has developed full-fledged research capabilities covering multiple areas such as infrastructure research, economic research, capital market studies, policy analysis, etc. Focused on the MENA region, Marmor is focused on serving the interdisciplinary knowledge needs of its clients and stakeholders. In today's session, I shall highlight the implications of low oil prices on liquidity in the GCC financial system. Specifically, I shall elaborate on its effect in banking system, equity markets, and debt market. Finally, I will discuss possible policy actions to tide over the situations. Questions, if any, could be asked anytime during the course of webinar, and it shall be addressed at the end of the presentation. A recording of the presentation will be sent in a day or two, and the same shall be uploaded in the Marmor website and Marmor YouTube channel. Questions can also be mailed to my email ID, which is rdeenadayalan, rdeenadayalan @marcus.com. We'll start with the presentation now. The presentation has been divided into three distinct parts. In the first part, I will discuss about the implications of low oil prices on GCC economy. And in the second, the detailed effect of the low oil prices on the banking system, financial markets, like the equity market and debt market shall be dealt with. And in the third, we'll be discussing some possible policy actions to tide over the crisis. We'll go ahead with the first section. As you are aware, there has been a tremendous fall in the prices of oil. The oil prices have fell almost by 60% since the start of since June 2014. The fall in oil prices could be attributed to a host of factors, such as the weakening demand in Eurozone and in China, and the excess supply in the oil markets, primarily due to the shale oil revolution and continuous production from the OPEC nations, which almost contribute 40% to the oil market. If we look at the oil prices from the historical perspective, 1861, the historical prices have been, the average of the historical prices has been $34, and currently the oil market is trading at $40, and this situation is not expected to recover anytime soon. If you look at the various investment banks and international institutions such as World Bank, which comes out with forecasts for oil prices, most of the oil price forecast for the end of 2016 has been pegged around $50 to $60 per barrel. So what we believe is this low oil environment may not be able to recover as soon as possible, and this situation of prevailing low oil prices could present the GCC nations with a host of multiple problems. For one, in this chart, we have depicted the break-even, physical break-even oil prices. And if you see, the red dotted line is the current oil prices. So if you see, most of the GCC nations, their physical break-even prices are much higher than the current oil prices. So what essentially happens is most of the GCC governments may not be able to balance their budget. And ideally, if the average prices tend to be maintained at a very low level, much below than the break-even oil prices, they could possibly go into a deficit situation. And this deficit situation could be anywhere between, for Kuwait, maybe it could be flat, and for Saudi Arabia, it could even plunge to 15 to 20%. And IMF, in its recent outlook, it has pegged that the lower oil prices could sizably affect its export revenues. For GCC region as a whole, the loss in export revenues has been pegged at $250 billion, which is almost like 23% lower than the level registered in 2014. And this $250 billion is almost equivalent to 20% of the GDP of GCC region. This combination of lower oil revenues amid increasing on elevated expenditures, which we can infer from the chart, which has almost rose by 25% in the case of KSA over the 3 years, could complicate the fiscal scenario for the GCC countries. And if we see the expenditure mix of the GCC countries, most of the expenditures has been in the form of current expenditure, which are hard to manage. And these current expenditures primarily consist of salaries and wages for the government employees, various subsidies, the fuel subsidy, the water subsidy, the electricity subsidy, etc. And the remaining would amount to the capital expenditures, which are more productive for the economy. The combination of lower oil revenues due to the lower oil price environment and the increasing expenditures could tilt the fiscal scale from a surplus situation, which has been until 2014, into a drastic deficit situation in 2015. Based on IMF projections, we believe that the GCC physical balance will tilt from a surplus of 4.6% of GDP to minus 8 percent of GDP, which is quite drastic for the region. However, despite the situation, if you look at the current debt levels of the GCC economy, most of the countries, the big weights, especially Saudi, Kuwait, and UAE, they have very low debt level compared with the G7 countries or the European Union, whose gross debt as a percentage of GDP is somewhere between 90 to 120 percentage. So this sort of acts as a cushion in the short term, as these governments could add on debt to tide over the crisis in the short term. Also, a factor which acts favorably for the GCC governments is the sovereign rating, which is in the top three notches, especially for countries like Saudi, UAE, and Qatar. This is a pictorial representation of sovereign ratings of almost all the developed nations and developing countries. If you see the GCC countries which have been highlighted in blue, they are still in the investment grade, and that's comforting. This sort of provides some sort of short-term comfort for the GCC countries. And in 2014, despite the fall in oil prices in the later second half of 2014, most of the governments still stuck with their budgets for 2015. And that's one of the reasons why we never saw the economic activity being affected as much as it is being currently projected now. If you see, most of the governments, despite registering a deficit situation, for example, Kuwait, Saudi, even despite they registering a budgetary deficit in 2014, they still maintain their expenditure levels as much in 2013. So thus the economic activity was sustained in 2015. However, the persistent lower oil price environment may not be may not help the governments to sustain the same level of expenditures unless they take some drastic measures. So with this being the scenario, wherein the oil price environment is continuously persisting for almost like 1.5 years now, and with most international organization and investment banks not expecting a recovery in the oil prices, the GCC economies are bound to shift from a position of fiscal surplus to deficit, and this scenario could have multiple implications in the financial system, especially the banks and equity markets. So let's now assess the likely impact which this altered environment would provide on the banks, equity markets, and debt market. The most visible impact of the lower oil price environment is felt in the deposit mobilization process of the banks. If you see in these charts, it's very clear that the deposit growth has lagged behind the credit growth. And if you see the government deposits accumulation in the government banks, in the banks for Kuwait and KSA, they have plunged into the negative territory. This just means that the government deposits are not happening anymore. This could be due to a variety of reasons. One, the government, due to the loss of revenues from oil, they are not able to generate surplus which could be deposited in the banks. And two, to tide over the problem, they have been continuously drawing down on their savings. and this has led to a sharp rise in the interbank rates. This chart ideally provides you the 3-month interbank rates, and the below table you can see the rise in 3-month interbank rates in the past 6 months. The effect has been enormous in the case of Bahrain and KSA. However, if you look at the current banking system, for all the banks, they have been currently well capitalized, as evidenced by the capital adequacy ratio. It stands much higher than the Basel limits of 12%, and they have sufficient cushion too. Uh, Even the non-performing loans for Saudi and Qatar, some of the major banks, it's still well below 2%. So in the short term, the governments could pitch in with funding the government, but however, the banks cannot be the sole source of funding for the government to tide over the deficit. For instance, Standard and Poor's has said that the KSA domestic banking system can only withstand financing the government up to $100 billion. If it's going to exit, then it could put a lot of pressure on the banking system. And apart from the banking system, even the domestic debt markets has witnessed a lot of activity in the recent times. The most drastic impact was the issuance of sovereign bonds by the KSA government in the domestic banking system. For the first time in 8 years, Saudi Arabia went ahead and placed its bonds in the with the local banks, and it almost raised like 27 billion. And since this system cannot be sustained, it is also widely expected to access the international debt market in the coming year. This is a chart which we made to make to put things in a better perspective. This clearly shows the levels of money raised by the corporates in the debt market, along with sovereigns. If you see in 2009, when the financial crisis happened, there was a spurt in the government lending, government borrowing, sorry. And post the years, due to the elevated oil prices, the governments were in a comfortable position. But again, in 2015, you could see that the government borrowing has actually uh, outpaced the corporate borrowing. And if you also see the pie chart, the government borrowing has always been restricted to 10 to 15% or 20%. But in the current scenario, it has almost overshot 50 percentage. So that's the kind of situation which the governments are facing, and they have been raising a lot of money in the debt market to plug the deficit. These are some of the recent bond issuance. Again, if you see, the top three has been occupied by the uh, government uh, governments of GCC. Majorly, Qatar raised a 5.5 billion dollars at a Libar rate of at a rate of Libar plus 90 bips, which was the spread for the Qatar government. While in the case of Bahrain, since its financials are quite deteriorated when compared with Qatar, it was able to raise only 1.5 billion dollars, and that too at a much higher rate for the 5-year term and 10-year term. Uh, this is also due to the low sovereign rating of Bahrain. And if you see the CDS spread, as in the credit default swap spread, this has recently changed by a significant amount. The blue color line specifies the change in spread, and while the other maroon color displays the spread. So if you can see, for most of the countries, especially for Saudi and Bahrain, which are in a very perilous situation, the change in spread has been almost by 50%. So that kind of shows the nervousness of the debt players in the CDS market. And one of the impact of the GCC governments borrowing so much of money from the debt markets is the private players are no longer able to borrow money from the domestic debt markets. For instance, the Abu Dhabi Commercial Bank (ADCB), it had to cancel a 500 million dollar issue, since it felt that it wasn't able to attract a lot of investors to its issue. This is majorly due to the fact that since the governments are placing their own bonds with the banks are no more, they don't have that much of excess cushion and capital to bid for other private issuer borrowings. And also when they go ahead and issue bonds in the international market, most of the players, on account of looming Fed rate hike and the situation which is happening in the GCC due to lower oil prices, they have been demanding excess spreads to cover their risk. This is just a flow chart which is ideally expected to happen because of low oil prices. As low oil prices happen, what essentially happens is government will lose out on the export revenues, and this export revenues will result in lower debt deposit mobilization by the governments. And due to the lower deposits happening in the banks of GCC nations, they won't be able to lend out more, especially to the constructive purposes and to corporate borrowers or to households. And in addition to this, the governments are also actively drawing their savings, and they are additionally placing a lot of debt with the banks. This crowds out the market for private borrowers in the domestic debt, leading to shooting up of interbank rates, which we saw. And ideally, this could raise the cost of capital, and this could, actually slow down the investment capacity in the private market. Let's also discuss about the effect of this liquidity in the equity market. The major determinant for equity market is the corporate earnings. As we have just seen above, the increasing cost of capital would prohibit or would hamper the investment activity of most of the corporates. And already in 2014, the earnings contracted by 3%, and the earnings actually rose by 11%. We have it in the above table. And in 2015, the expectations is that the earnings will be very flat. And going ahead, one would not be surprised even if the earnings contract. And contraction of earnings along with the valuation multiples as witnessed by the price to earning ratio, which has been contracting, and on average they have decreased by 20%, 25%, doesn't paint a very optimistic picture for the equity markets. And add to the contracting of valuation multiples and earnings which have been growing weak and very subdued, the liquidity levels in the stock market have also been decreasing. While in 2014, due to a flurry of activity, especially the opening of the announcement of opening up of Saudi markets and inclusion of UAE and Qatar indices in MSI stimulated a lot of activity. It wasn't sustained in 2015, and the value traded has been going down. And if you see, it has almost declined by 35% in 2015. And due to the lower ability of the governments to dole out credit in the situation in Kuwait, we can see that the credit offered for purchase of securities has also been very low. It has steadily decreased from 25% to almost 20% from 2013 to 2015. So this reduces the retail activity in the local markets, thereby further hampering the any possible movement in the indices. So here you can see the snapshot of the GCC markets along with the oil price in the last row. Most of the markets have been negative. The data is as of November 30. So you can see the GCC markets mirroring almost the loss exhibited in the oil markets. This is primarily due to the not so optimistic outlook on the earnings front, along with the contraction in valuation multiples. So this being the situation, what could possibly the governments do? I mean, what sort of reforms are essential to tide over the crisis, and how essentially could one manage their portfolio or position the portfolio? What needs to be done is GCC economies, despite various diversification efforts, are still being highly reliant on hydrocarbon activity. For instance, In Kuwait, almost 50% of the activity is hydrocarbon dependent. And the situation is no different in other GCC government. Apart from the economic activity, even most of the revenues which the governments take, uh, it's all derived through the hydrocarbon source. With Saudi Arabia being most dependent on the hydrocarbon revenues. For almost all the GCC countries, hydrocarbon revenues still contribute over 50%, with Bahrain, Oman, and Saudi Arabia being most reliant on hydrocarbon revenues. So, any talk of reform should ideally target these two factors in the near term. And we were also saying that the expenditures have been on the rise, and the expenditure mix is mostly skewed in favor of current expenditures. If you see the subsidies as a percentage of GDP, most of the subsidies are happening in Saudi Arabia. This is the total subsidies which are being offered, 6.55 as a percentage of GDP, and we can see the split up of subsidies as for different components like fuel component, electricity component, and food. While food subsidies are very lower, fuel and electricity still form a sizable portion of their subsidies. So targeting these subsidies would be the right way to go forward to adjust to the situation of lower oil prices. And to make the understanding more clear, what we have done is we have identified how much of subsidies would ideally form part of the current expenditures. If you see the graphs, we can clearly see that the Saudi Arabia offers almost like 30% of its expenditures goes in subsidies, and the next country would be Bahrain, wherein 20% of the expenditures are utilized for subsidies. With this being the case, UAE government has taken the initiative to deregulate the fuel prices. I took the decision in 2 or 3 months back, wherein it completely deregulated the retail fuel prices, and now the prices are being adjusted depending on the international crude trade basket. We can clearly see that while the world average for gasoline prices are being $1 per liter, most of the countries, especially Saudi Arabia and Kuwait, they charge only 16 to 20% of what ideally is the market price. So you can see this big gap of 80% of the fuel prices being subsidized for the local citizens. So targeting this fuel subsidy would be one of the way forward, and which is what the UAE government has done. But we all know that the UAE market is dominated by expats, and it's easier to come out with the regulation to deregulate prices. While in other countries like Saudi and Kuwait, a lot of local citizens are part of the population, and hence uh, they might face some political hurdle in coming out with the regulation as such. But then again, there are multiple options for the government, which we'll be seeing in the next few slides. Um, uh, Other than tackling the fiscal subsidies, one of the major thing which they can do is come out with fiscal reforms. When we talk about fiscal reforms, one is like they can rationalize the expenditures, which involves like scrapping up of non-priority projects, making prioritizing the expenditures and focusing more on infrastructure projects which have a lot of trade-off for and greater multiple for other economic activities. At the same time, since most of their revenues are predominantly hydrocarbon driven, they could also consider introducing taxes, maybe in a phased way, starting with big corporates, and then slowly taking it towards the SME. And apart from taxes, they could also look at increasing the service cost for various government services, like there are various forms and services which the governments do. So all those services could the cost could be raised, and that could serve as a revenue stream too. And even in case of countries like Saudi and Kuwait, wherein they could face some political constraint to implement subsidy reform, we suggest some ways to overcome that. The first and foremost is there has to be effective communication regarding the problem being faced by the GCC governments in managing their finances, and in this environment of low prices. And there has to be a clear white paper stating what essentially is the subsidies which is being offered to the citizens, and what are the various ways in which it could be better utilized, such as the investments that could happen in the infrastructure. So clear and effective communication to the citizens is the need of the hour. And apart from that, subsidies should not be seen as a way to distribute the wealth, or rather, help the people to increase their standard of living. Subsidies should be directed towards places where it's most required. For that, we have suggested three approaches. One is tiered subsidies, smart subsidies, and targeted subsidies. In each of these scenarios, what we essentially try to do is we try to ensure that the subsidies reach the place where it's most required, and we can avoid excess consumption and leakages of subsidies. And as we know from international examples, subsidies are more prone to leakages, and they are not an effective way of increasing the standards of people, or as a or it may not be the proper way to distribute wealth. So for that, we could ideally consider alternatives such as direct cash transfer to those who are in need of subsidies. And there is always a question of which comes to the public debate, wherein the GCC governments are faced with the, one, either should they liquidate the sovereign wealth funds to plug the deficit, or should they add on debt since they have very low debt. So we have just tried to arrive at a formula, or which we call as physical fitness. The arguments which speak in favor of issuing debt by the GCC sovereigns are the high sovereign ratings, which are even higher for some of the countries than the developed nations, and two, the very low debt levels as we see when compared with the G7 countries and the EU nations. And also the external environment offers a very conducive place, as the interest rates are very low currently, and with the impending rate hike, they may not be, we could witness a sort of maybe a 15 bips or 25 bips rate increase. But then since the interest rates are at a historic low, maybe the GCC government should take the initiative to issue debt and lock in at this rate. And apart from these, they could also consider this threat of lower oil prices as opportunity, wherein they could develop the debt market, which is very essential to provide alternative means of financing apart from the equity markets. And it could also help in creation of benchmark yield curve, which many people have been advocating in various conferences. And also, taking up of debt by the government will instill a sense of discipline, as would entail a, series of payments annually to cover the interest charges. And this could also, in a way help to tackle the subsidies, as the spending will become more disciplined now. And if you look at the characteristics of sovereign wealth funds, most of those funds are established with the view of very long term, and they ideally serve to generate intergenerational equity. When I say intergenerational equity, it means that the funds target investments wherein they try to get returns which help them to sustain on a perpetual basis, rather than depleting the capital base. And when we look at the sovereign wealth fund ratings, the ones which are publicly available, over the past 10 years and 15 years, the Norway pension fund, which manages some 800 odd billion dollars, they have been able to provide annual returns of 6.3%. And even the South Korean pension fund has generated returns over 6%. And since the return information of sovereign wealth funds are quite sparse and very difficult to collect, we can assume these funds as a proxy, and it would be safe to assume that on a long term they could average returns of 68%. And considering the debt cost, which based on the debts issued by the government of Qatar and government of Bahrain, we believe that the top ones, especially Kuwait and Saudi Arabia, which commands good sovereign ratings and which doesn't have much of debt, they could easily raise a debt or issue sukuk, the Islamic form of debt, within 4%. So if you see the trade-off, we believe that the government should go ahead and issue debt rather than liquidating the sovereign wealth funds. So this is the summary of impact. Uh, which we have discussed. For banks, the primary criteria is the deposit mobilization process, which has been affected. And since the GCC governments are attacking two ways: one, they are drawing down on their savings, and two, they have been placing too much of debt. This ideally crowds out the debt market for the local corporate players, and it also has resulted in shooting up of interbank rates. So that's one. And with regard to the equity market, we have seen that the market has fell in tandem with the fall in oil prices. The valuation multiples have decreased, and corporate earnings, which have been subdued in 2015, are not expected to pick up anytime in 2016. And the market's outlook remains quite negative, with the oil prices again falling by 10% almost since December 2015. And in the debt market, we can see that the wider spreads are being demanded for GCC bonds, and corporates have been finding it difficult. They are not unable to place any bonds in the local market, and we have seen various issues such as ADCB pulling out their bond issuance, and hence the governments, instead of stressing up the financial system, they should take the initiative to establish the local debt market, and probably they could themselves tap the international debt market, uh, uh, and thus free up the space in the domestic debt market. So with this, we come to the end of the presentation. Questions, if any, could be asked now. Yeah, we'll be taking the questions now, and the recording of the presentation will be sent to all the participants in a day or two, and the same shall also be uploaded on Marmo website and our YouTube channel. We'll wait for the questions from the participants. Okay, one of the participant has asked, we have seen some credit rating agencies cutting ratings for Bahrain and Oman, and how will this impact? Yeah, I mean, this is just a reflection of the ongoing scenario in the GCC economies, wherein the lower oil prices are putting stress on the banking system and the financial space, and this is the rating cut is the outcome of this. So what essentially happens with the rating being cut is, ideally we believe that the rating has been downgraded by one notch, maybe from positive to negative and so on. So ideally this would increase the cost for those governments for whom the ratings have been cut in the international markets. So that's one thing. And we have another question from a participant. And the question is, do you believe that there will be drastic policy changes by Saudi Arabia? As we have seen, the majority of the impact will be happening in Saudi Arabia. And because the fiscal surplus is expected to go somewhere between 15 to, sorry, the fiscal deficit is going to be somewhere between 15 to 20%, which is quite enormous. But however, in the short term, if you see, the debt levels of Saudi is in low single digits, probably 5% of its GDP, and it also commands a very good sovereign rating. So the Saudi government has also been proactive by raising money in the local debt market, and it's also widely expected to tap the international market. So in a sense, Saudi could cushion the impact in the short term, so maybe 6 months time. And we need to further gauge the actions taken by the Saudi government with regard to revenue augmentation measures, whether they are able to bring in any regulation with regard to subsidy cuts and increase other revenue streams by introducing taxes. But as such, we don't see any drastic policy actions. There have been already numerous reforms going on in Saudi, and we believe in the short term at least Saudi government will be able to sustain it. But however, we also need to have a close eye on what essentially is happening in the oil markets and when essentially oil markets will find a bottom. So based on that, the policy actions will be. Another question is whether any rating cuts recently, if yes, which GCC countries? Okay, I think there was a rating cut with regard to women, but I'm not very sure since our presentation is more focused on the liquidity and its impact. And there is one other question: will the entry of Indonesia into OPEC further pull the oil prices down? Uh, this is a Okay, we are now in a situation wherein the oil markets are being flooded with new supplies. We have this Iraq pumping up their production levels. We have Saudi Arabia, which has been very unrelenting in putting a ceiling on their production level. And apart from that, we have Iran, wherein the sanctions are being lifted, and even it's about to join the oil market, and it's on its way to increase the production. And the usual you know supply disruptions which happens because of geopolitical risk in various West African nations, and have not been happening. And even Russia has been steadily pumping out the oil, and even shale producers, they have been very resilient, despite many calling that the shale market or the shale boom would ideally reduce below the prices of oil going down below 70 degrees. So in such a situation wherein we face a supply glut, the entry of Indonesia is bound to add further salt into the wounds of the oil producers. And unless any coordinated policy actions are being taken by the OPEC producers, wherein they put in a ceiling for the oil production limit, we believe that this only has the capability to pull down the prices still further. Uh, there is another question with regard to ratings. This question goes, the question is, will the current trend of raising debt levels by the GCC governments lead to rating cut? Okay, ratings are primarily determined by various ratios and the debt servicing capability of the government. So merely raising the debt level may not lead to an instant rate cut, and it's not a very dynamic process. The process is quite static, wherein the rating agencies take their own time to understand the implications of the new levels of debt and the ability to service. So the mere action of raising the debt won't lead to a rating cut, but various other factors would be considered, such as the current levels of debt, the ability to service it, and depending on various other the interest coverage ratios and stuff, and based on a holistic model, the ratings will be decided. And with this, we come to the end of the webinar. We'll be sending the recording of this presentation in a day or two, and the same shall be uploaded in Marmor website and YouTube channel. On behalf of Marmor, we thank all the participants for their participation. Thank you.